Good day, this is your European Open briefing for Wednesday, June 15th. I'm Michael Frentiades, Chief Economist at XM.com. And today's key points are: the euro was under pressure yesterday because the German 10-year bond was for the first time in its history is having a negative yield. And we also have some safe haven flows related to Brexit. We had US retail sales coming in strong yesterday, which helped the dollar. We have the Fed meeting ahead today. We are waiting mainly for some guidance and not any action. The yuan hit a 5-year low versus the dollar, and the Chinese shares were again excluded from the MSCI indices. And finally, the calendar. We have UK unemployment, United States producer prices and industrial output, crude oil inventories later on, and of course the Fed decision report, quarterly forecasts, and Yellen press conference tonight. Moving on, we see the steep fall in the euro yesterday from the 113 mark. It dropped to below 112. As we said, the negative German 10-year yields are weighing on the currency, as do the concerns about Brexit and the impact it will have on the European Union and its economy. I think that there might be some speculation that the ECB will also be forced to act in a sort of emergency fashion if Brexit does indeed take place. So maybe some euro selling ahead of possible ECB action if Brexit takes place to calm the markets. We are also seeing a new 3-year low, a more than 3-year low of 118.50 for euro yen. It has recovered since that particular level was hit. We have the yen benefiting from Brexit woes, and it's worth saying here that investors and traders are looking for proxy bets instead of plunging straight into pound crosses. Pound crosses have a huge gap and liquidity risk, so it's possible that traders are betting or putting bets on Brexit, let's say, or trying to hedge by using other currencies such as the yen. The US dollar is also a relative safe haven, not as much as the yen, but it's also expected to be a winner, as we saw from the action in euro dollar, by the way, yesterday. Having a look at the pound, we see cable hanging on yesterday, and today it's holding on to the 141 level, and this is despite the, let's say, negative news flow in terms of polls and betting odds that are showing that are favorable for the Leave outcome. So sterling is hanging on to 141 versus the dollar for the time, despite the bad news. On to retail sales. Here we are showing the year-on-year change. It's around 2.5%. The month-on-month figure was 0.5% actual versus 0.3% expected. And the control, which is very important measure of retail sales, goes into GDP calculations actually, came in at 0.4% versus 0.3%. Now, this report was important because it shows that the US consumer was doing okay in May despite the poor jobs report. And generally the evidence we are getting since the jobs report is pointing to the possibility that it was an outlier. We'll have to see about that, but we haven't seen so much evidence backing that the US economy is going to fall off a cliff. Here we see what's happened since the jobs report, and we hit very low levels for the US 10-year yield. We briefly reached similar levels around 158 in February when we had the market turmoil, but to find levels below that, we have to go all the way back to 2013 when QE was still happening. So these are indeed very low levels for the US 10-year yield. Now, what has driven this to such low levels? The drop in German yields is helping because as bond yields around the world fall, a lot of investors, that increases the demand for US bonds, and that pushes the yield of US bonds also lower. We also have a bit of a risk of sentiment. The S&P was also a little off yesterday, not as dramatically as European stocks, which fell much harder, around 2%. We had a 2% drop, which is quite a sizable move. So there is no Fed action expected, since the yields are showing us that they are relatively low. We see the 2-year yield, which is the yellow line, falling from around, this is the right-hand axis, falling from around 0.9% before the release of the jobs report to around 0.73% right now. And this is a good indicator of what the market expects Fed is going to do the next 2 years. So we've seen a drastic repricing of what the Fed is expected to do. Now, in today's statement and press conference and reports, as we said, we're not expecting any action, but the market is concentrating whether the Fed is going to revise its view to expect 2 rate hikes until the end of the year. So we are getting a new dot plot. So that's what the Fed governors expect interest rates will be for the next few years. So that should be interesting, because the market is only expecting 1 rate increase until the end of the year now. Important to note. On to the calendar. We had New Zealand's current account today, which beat expectations slightly better. The French CPI was revised up. We have UK unemployment expected to hold on to 5.1%. Of course, average weekly earnings and ex-bonus earnings are going to be watched, and as well as the claimant count. But given the focus on Brexit, again, UK data may not be so as important as speculation on what's going to happen with Brexit. Now, later we will get the start of the US session. We get US producer prices, and around 0.3% final demand, so year on year to be slightly in deflation, minus 0.1%. Industrial output is going to be interesting, minus 0.2% expected, and capacity utilization. And of course, crude oil inventories, expecting a draw of 2.26 million barrels. Crude oil inventories are important as oil is under pressure on global growth concerns. And of course, in case you forgot, the Fed tonight is what the markets will be watching after all this is announced. So, that's all from me. Have a great day. Thank you very much for watching.